couldn't let you get away without an investment session. So clearly there's a fairly enormous amount going on at the moment in terms of geopolitical scene, global news flow, etc. But I think, clearly in our experience, most charities are investing for the pretty long term. And so what Adam and I are going to try and talk to you about today is really with the long term in mind, specifically as the slide suggests, what the investment landscape might look like over the next decade. So if I could sort of set the scene first. Clearly there's been a reasonable amount, as I said, going on in the last sort of 50 days associated with a certain new person in the White House. But actually, even the first few years of the 2020s have been pretty turbulent. And I don't think it's an overstatement to say there's been some fairly huge shocks to the global economy already. Namely, of course, a global pandemic, the biggest land war in Europe since the 1940s. And I'm sure I don't need to remind you there's been a reasonably high amount of market volatility to accompany both those events. But looking sort of way back in time, we can actually see quite a few parallels with where we were just over a century ago. Back then, the world was dealing with the aftermath of World War I. There was also a global pandemic, and there were some real bouts of very high double-digit inflation as well at that time. And actually what we saw around then was we had this period of globalization leading up to World War I, preceding that, and that really came to sort of a screaming halt. And the global economy set up in a fairly drastically different direction following the First World War over the course of the 1920s. And so I think as long-term investors, it's important for us to sort of see if there are any parallels and really ask what might be coming next this time around. Are we set really for a return to the 2010s? Or is, as was the case in the 1920s, are we set on a different course and might things look rather different, in which case we think might require a fresh approach. So those are the key questions we're going to try and shed some light on today. We are going to draw on the sort of conclusions from our long-term forecasting framework at Rathbones, which is one of the key inputs into our asset allocation process. I think probably just a word of caution to start with as well, is that clearly over the types of time horizons we're talking about today, making predictions is quite challenging. So we'll try and be as sort of transparent as possible about our methods and our assumptions, which is what we'll endeavour to do today. So we'll split the presentation into three main sections. First, we'll deal with the economics. You can probably have a guess at what our conclusions are from the title of that one. Effectively, we'll explain why we think the global economy will look different over the next decade than what it has in the past one, starting with inflation and interest rates before moving on to growth. Second, we'll turn to kind of the key assets most charity portfolios are populated with, starting with fixed income, and look at what a change in the economic regime might mean for that asset class. And then third, we'll discuss the outlook for stocks in this new environment that we envisage. I'll hand over to you to kick off.
Thanks. Yeah, so before we get on to our expectations of inflation and interest rates for the next decade, I think it's first worth reminding ourselves just how remarkable the experience of the 2010s really was. So this first chart that you can see on screen shows short-term interest rates in the UK back to the beginning of the 19th century. And you can see that the 2010s are clearly the outlier. We saw the lowest interest rates in hundreds of years worth of history, even lower than the period during and immediately after the Second World War. That decade also stood out when it comes to inflation volatility. We saw about the lowest inflation volatility in over 3 centuries in the 2010s. I think putting that decade into perspective like this really shows how it's possible that historians might look back on that as the anomaly. And as a result, it shouldn't take too big a leap of faith to see the new normal over the next decade looking a bit more like the old normal that preceded the 2010s. The chart on this slide shows how we think on the inflation front that will prove true. So the dark blue bars show average inflation in 4 major economies in the 2010s, Most, as you can see, are below the 2% that many central banks target. The lighter blue bars show our projections for the next 10 years. In contrast, they're generally slightly above 2%. So why do we think this will be the case? We think there's four main reasons. First is that the risk of another geopolitical shock temporarily pushing up inflation seems significant. I think the past year or so makes a broader regional conflict in the Middle East seem more likely, and China has become increasingly assertive with its dealings towards Taiwan as well. Those sort of geopolitical shocks usually lead to higher inflation. Second, the conditions that underpin the demand-efficient economic environment of the 2010s seem to have changed. Households spent years after that crisis trying to rebuild their balance sheets, and the fiscal support provided during the pandemic has generally strengthened them further. Overall, then, households are probably in a bit of a healthier position than they were in the early 2010s. And the experience of the pandemic also helped governments rediscover their appetite for activist fiscal policy. So while the first half of the 2010s was defined by fiscal austerity, there appears to be little will to impose that sort of belt tightening today. Third, the pandemic provided an additional catalyst to deglobalization. Now, that arguably got underway before the pandemic, but since we've seen the US continue its protectionist shift under Joe Biden, and I'm sure I don't need to recap what's happened in the past few weeks in the US either. But away from the US as well, the EU has also been re-examining its trade relationship with China in particular. Fourth, climate change is driving a higher frequency of extreme weather events, which may also contribute to greater volatility of inflation. The spikes in the prices of olive oil, cocoa and coffee are just recent examples of that. Climate change is also putting pressure on many governments to invest more in mitigation and adaptation efforts. That further contributes to demand. So there's quite a lot going on. How bad could it get, you might ask? Are we in for a rerun of the 1970s? We don't think so. So for one, the labour market looks very different. Back then, the power of unions was key to driving the wage price spirals that kept price pressures so strong. Unions just don't wield the same sort of power today. Otherwise, household expectations of inflation also rose sharply in the 70s. That poured fuel onto the fire, but there's little evidence of that being true, at least in the UK today. Even after the recent bout of inflation, expectations in the long run are only marginally above where they were in the 2010s. What's more, central banks are more committed to controlling inflation in a way that they just weren't back in the 70s. Legally mandated inflation targets are now the norm in the developed world, and speculation that they would relax those before the pandemic has amounted to essentially nothing. Although policymakers were initially slow to respond in 2021 and 2022 to inflation, they ultimately delivered the most aggressive interest rate hikes since the early 1980s, and they spoke explicitly about avoiding the mistakes made during the 70s. On this next slide, you can see our projections for average interest rates in the UK and the US over the next 10 years, and for context, we provided the past century. As you can see, we think that interest rates will be closer to their pre-financial crisis norms. We also think they'll be more volatile than in the 2010s in response to the higher inflation volatility that I've just spoken about. On balance, that leaves us somewhere close to the 1990s or the 2000s. We aren't expecting an environment where inflation strays miles away from 2%, but we do think it'll be a bit higher and that central banks will have to work a little bit harder to control it. Rather than worrying about inflation falling too low, as was the case before the pandemic, we now think that policymakers will be focused on preventing it rising too high, as they are right now. So moving on to economic growth, we aren't expecting the same sort of regime change as we are for inflation and interest rates. Some themes from the 2010s we think will continue, but also we think new ones will emerge. To start with, we can say with some confidence that the demographic headwinds that we saw in the 2010s will continue and, if anything, intensify. Low birth rates mean that working age population growth will slow across the globe in the next decade, going into outright decline in some regions. This chart shows the UN's latest projections from their 2024 forecasts. China is one place where demographics will be a particular challenge. The working age population there has already declined, and it's set to shrink even more dramatically over the next decade. But among developed markets as well, demographics are a key reason why we expect slower economic growth in Japan and the Eurozone than in the US, and also to an extent the UK, where the working age population seems like it might avoid an outright contraction, although the assumptions there are quite reliant on migration. Elsewhere, we think there are reasons to be a little bit more optimistic. One is that we're factoring in an offset to those demographic headwinds from higher public investment. The earlier 2010s in particular were notable for the weak state support for investment during those years of austerity. Since the pandemic, we've seen the rebirth of industrial policy, particularly when it comes to sectors such as energy and semiconductors. In the US, we've had the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and the Chips and Science Act, all passed under President Biden. I don't think we can be quite as optimistic on this front under President Trump. He's pledged to row back on some of those plans, but a good chunk of the money has already been spent, and those down payments could continue to be a tailwind for growth. And while public investment in the US may not be as strong over the next 4 years, Trump's approach so far has spurred policymakers in the EU to rethink their strategy. We've already seen some initiatives in the wake of the pandemic from the EU on this front, but I think the past few weeks we've seen a complete turnaround in the approach in mostly Germany, but also the broader European Union, in an attempt to borrow more to invest both in defence and in infrastructure. It's early days, and there's definitely going to be hurdles, both politically and logistically, to doing so. But our judgment is that this does improve the long-term economic outlook on the continent. The UK, just for a sort of a side note, is a little bit further behind, but the Labour Party has removed further big cuts to public investment that had been penciled in under the previous government. Aside from all of that, there's also the possibility that AI and automation helps boost productivity growth after a particularly poor experience in the 2010s. Now, we haven't factored in any explicit assumptions here yet. That's not because we don't believe in the potential of the technology, but because there's such enormous uncertainty about its broad economic impact. Historically, the pattern has been that major innovations have little to no impact on broad measures of productivity initially, even though some particular industries are transformed. But it's once the tech has diffused throughout the entire economy that the impact in the aggregate economic statistics becomes clear. So if we take the IT revolution as an example, innovation and the development of computers was well underway before the end of the 20th century. Computers made their way into universities and businesses from the 1970s and homes from the 1980s, or so I'm told. But you wouldn't have guessed that looking at the productivity data. It took until the 1990s to see any effect. There are good reasons to expect the transmission of AI into the broader economy to be faster than that, but I think we're still likely to be talking about only beginning to see economy-wide effects towards the end of our 10-year horizon. So where does that all leave us? Overall, we're projecting economic growth that will be roughly similar to the 2010s, and that's what you can see on this chart with the crosses on the right-hand side. The UK is in the dark blue and the US in the lighter blue. Our 10-year projections, as I said, are the crosses on the right-hand side of the chart. As you can see, we also expect economic growth to remain faster in the US than the UK, although we think the gap could be a little bit smaller than it has been over the past few years, when the US has steamed ahead, helped in particular by very loose government spending and some relative insulation from an energy price shock in the UK. So that brings us to the end of our economic projections. To quickly summarise, we think that inflation will be higher and more volatile than in the 2010s, but we aren't expecting a rerun of the 1970s. We think interest rates will also be higher and more volatile as central banks respond to those trends in inflation, and we think that economic growth will be broadly similar to how it was in the past decade. So I'll hand over to Olivia now to talk about what all this means for the world of fixed income.
So I think as this chart shows, fixed income assets have already undergone a pretty significant repricing as part of this shift to the higher interest rate environment that we've described. And as this chart shows, yields on government bonds, specifically in the UK and the US, are very close to are really at their highest level in 15 years. And so you can now lock in a yield well north of 4% for 10 years per annum, so 4% per annum, whilst taking little to no credit risk. You know, this is government bonds, so very limited risk that you won't get your capital back. And that's a really big departure from the 2010s, when the same proposition was going to give you around 0.5 to 1%. And so the end of sort of ultra-low rates has very much brought about the end of ultra-low yields from fixed income. And so those higher yields clearly provide a more attractive entry point for most fixed income assets today. And that's really kind of a significant influence on our projections for returns from this asset class going forwards over the next decade, which have risen in tandem as well. I should say that wouldn't necessarily be the case if we thought that interest rates and yields would continue to rise from here. But as we explained earlier, we're not expecting a sort of 1970s style skyrocketing of inflation and rates. So at face value, this might suggest that a larger allocation to fixed income sounds sensible and appealing in portfolios than made sense a few years ago. But we think there's a few reasons to be cautious here. So prospective returns aren't the only variable we should think about when we're looking at asset classes and planning out positioning. Specifically, there are two other factors that we would sort of highlight to consider that may temper one's enthusiasm about fixed income. The first is that if we do get increased volatility of interest rates and of inflation, as we've argued might be the case going forwards, then fixed income returns are highly likely to be more volatile as well. Higher returns are all well and good, but if you were hoping to get a smooth ride from your bonds, then that may be not what you were buying in the first place. So we think there'll be a much greater magnitude of swings along the way. As a side note, we think this should probably strengthen the case for careful active management within fixed income. Skilled managers should be better able to capitalise on those swings that you will see and make the most of more frequent interest rate cycles. Secondly, we think the relationship between bonds and equities might have changed as well. So in the last decade, we got used to a pretty reliable negative correlation between stocks and bonds, as you can see from this chart. When the series is below zero, stocks and bonds are moving inversely to each other, so in sort of opposite directions. And that meant that despite their lower returns, bonds still played a pretty useful role in portfolios, namely smoothing out swings in the equity market and sort of smoothing overall performance when it was needed most. That all changed, as you can see, in the last couple of years, with both stocks and bonds at times selling off quite aggressively together. At times when inflation surged. And as you can see from the chart, that correlation has flipped from negative to positive in recent times. Arguably, that's what we should have expected. Historically, there has been a relationship between inflation and the stock-bond correlation. This chart demonstrates that relationship using the UK as an example. So plotting inflation on the horizontal axis, and the stock-bond correlation on the vertical axis. So what it tells you is that when inflation is high on the right-hand side of the chart, we essentially only see a positive correlation between stocks and bonds. Meanwhile, when inflation is low on the left-hand side of the chart, we get that negative correlation much more often. So I think the axis is important. We aren't expecting inflation at the levels that populate the right-hand side of this chart to sort of guarantee that positive correlation in that area of the chart over the next decade. But I certainly think if it's more volatile, if inflation is more volatile, then it certainly seems reasonable to expect that correlation to be less reliably negative. I think this all highlights really the ongoing importance of owning assets other than just fixed income and equities in multi-asset portfolios. If fixed income is going to be less reliable at doing its job of offsetting equity risk in our portfolios, then there's certainly an argument to hold and maintain allocations to assets such as gold, precious metals, selective alternative strategies that have really demonstrated their ability to perform when stocks and bonds sell off together. So to summarise, we think structurally higher interest rates will mean returns from fixed income assets will be higher over the next decade. So really current yields, we think, provide a reasonably attractive entry point. However, returns are likely to be much more volatile from this asset class. And as I've said, there are reasons to believe that correlation between bonds and equities is going to be less reliably negative. So I think that brings us nicely on to the equity market itself and the prospects for that over the next decade.
Great, thank you. So that environment that we've been describing might sound like a bit of a tough one for equities, with higher interest rates and bond yields, slower economic growth, but we still believe that they're capable of delivering returns well above inflation over long time horizons. There's two main reasons why that's the case. First, we have explicitly accounted for all of that economic outlook in our equity return projections. We developed them from the bottom up, forecasting all of the individual drivers of equity returns in each sector and region. And second, history suggests that that will be the case. As this chart you can see on screen now shows, the effects of the economic cycle and geopolitical shocks tend to wash out eventually. Equities have a long track record of beating inflation over 10-year periods. Since the 1870s, there have been only 4 occasions where this wasn't the case, and each was associated with a major shock. So a world war, the 2 most severe financial crises of the entire period, or the extreme inflation of the 1970s. Taking our US returns projection as an example, which is indicated by the cross on the right-hand side of this chart, it doesn't look particularly downbeat by historical standards, though it is lower than the quite stellar returns that we've seen over the past decade. Looking back over that past decade, the performance of the US equity market doesn't just stand out relative to its own history, it also looks particularly strong relative to other markets over the same time span. Returns there have averaged 12% a year over the past decade. As you can see from this chart on screen now, other developed markets have failed to keep up by the US by quite a considerable margin. Japan comes in second place in local currency terms, but returns were still more than 3 percentage points lower per year than they were in the US. And the UK and Europe were even further behind, managing only around 6% annualised returns since 2015. Now, one driver of the outperformance of the US stock market has been the strong relative performance of the US economy, and partly by extension, there isn't a one-to-one relationship, strong earnings growth in the companies that are listed there. You'll remember from the economic slides earlier that we still expect the US economy to grow faster than other developed markets, and that is one input into our expectation that sales growth there will continue to be stronger than it is elsewhere. You can see that represented by the big dark blue bar on the second item on this chart. This is what breaks down our equity market return projections. And you can see how strong earnings growth is the most important driver of our expectation that the US stock market will continue to perform quite well. We expect US firms to continue to grow earnings faster than companies elsewhere. However, earnings aren't the only driver of returns. Another key component is valuations, which have also been behind the big outperformance of the US stock market over the past decade. They're represented by the light grey bars on this chart, and you can see it at the bottom of the North American column below the axis. In contrast to earnings, you'll notice that we expect valuations to shift from a tailwind for US equities to a headwind over the next 10 years. And the net result is that while we still expect total returns from the US, shown by the blue diamond at the top, to be solid and above those of other regions in local currency, we don't expect the gap to the rest of the pack to be anywhere near as large as it has been. You can see from our expectations that are in the region of 9% for the US, which is closer to the returns we expect from Japan, Europe and the UK. This chart dives into the valuation story hopefully a little bit more clearly. It shows the price to earnings ratios in North America, which is mostly the US, that's in grey, Europe in light blue and the UK in dark blue. You can see that back in 2015, US equity valuations were only slightly above what they were elsewhere. But since then, they've risen a very long way, while UK and European valuations aren't that much higher. In fact, the gap is now about as large as it's ever been. The straight lines you can see on the right-hand side of the chart, they show our projections for the next decade. And you can see that we still expect US companies to be much more highly valued than their counterparts this side of the Atlantic in 10 years' time. After all, the US market has a much higher share of fast-growing and high-quality tech firms, for example, that can just justify the premium they trade at over the rest of the world. but we think that gap will be a little bit smaller than it is today. Our empirical work suggests that the current gap can't be explained entirely by characteristics such as growth and quality. And if we compare apples for apples, investors are just paying that little bit more for firms with the same fundamentals in the US than they are in the rest of the world. And that's difficult to justify over the long run. And that's why we think there'll be some convergence in valuations over the next decade, which will make a difference to relative returns. But even if we're wrong and valuations just stay where they are, removing that tailwind of rising multiples would still clip the wings of US equities a little bit. Now, one more factor that could weigh on returns from US stocks for sterling investors is weakness in the dollar. Those returns I've been talking about are all in local currency terms, but the long rally in the dollar since the first half of the 2010s has left it close to its strongest level since the mid-1980s. The chart you can see on screen now shows the exchange rate compared to a basket of the US's main trading partners, adjusted for the relative rates of inflation in those economies. And this measure of the exchange rate tends to exhibit a degree of reversion to its long-term average over long periods of time, moving up and down in multi-year cycles. And that would suggest that over the next 10 years, it seems more likely than not that the dollar will reverse course and weaken than continue marching upwards. On top of this, we've conducted our own alternative analysis that uses the fundamental drivers of exchange rates, so things like relative prices of imports and exports, productivity growth and demographics, and we've reached a broadly similar conclusion. Relative to sterling as an example, the dollar currently appears quite a bit stronger than those fundamentals would suggest. And if we're correct, then that might subtract a percentage point or so from US equity returns every year over the next decade for a sterling-based investor. Although I think it's important to note that trying to put an exact timescale on such currency fluctuations is extremely difficult. Most of the academic evidence suggests it's essentially impossible to predict over a few months or a couple of years, so we can only really say this over an extended time horizon. Before summing up there, I think I really just wanted to stress that we're not expecting poor returns from US equities by any means, just the end of a period of exceptional outperformance. And that's what this final chart shows. You can see that the consistent outperformance of US equities we've seen since 2010 is actually rather unprecedented in historical terms. When the series rises above zero, or the x-axis, the US is outperforming, and when it's below zero, the opposite is true. And we should be cautious of extrapolating out recent trends. A look further back through history shows that relative regional performance tends to come and go in multi-year waves. So for a number of years in the early 2000s, for example, the US was a notable underperformer as the dot-com bubble deflated and markets elsewhere that had more commodity producer exposure boomed. So I think just to sum up, despite that sort of slightly tougher economic backdrop, we still believe that equities are perfectly capable of delivering returns well above inflation over the long run. Our bottom-up calculations suggest that will be the case, and we've got history on our side as well. The key difference really is that we expect over the next 10 years is for the US equity market not to be quite as dominant as it has been over the past 10 years. That's not to say we expect them to do badly by any means, just to revert to more typical levels of performance by global standards after a very exceptional period. So with that, I'll hand back to Olivia to sum up.
Yeah, so just really to recap, I think everything we've talked about. We think inflation and interest rates will be higher and more volatile over the next decade than the 10 years before the pandemic. But we're not anticipating a rerun of the 1970s by any means. We think economic growth will be relatively similar to the 2010s, despite worsening demographics in most of the regions in which we invest. Higher bond yields that have come about as a result of rising rates make fixed income more attractive as an asset class than it's been for some time. But we'd caution that the volatility of the asset class has also increased, certainly the case if inflation is indeed set to be more unpredictable. Equities, we think, would still deliver returns or should still deliver returns in excess of inflation over the long run. But I think the key difference with the 2010s is that we don't think US equities will be quite as dominant as they have been. And finally, we think that higher and more volatile inflation will mean that correlation between bonds and equities will be less reliable. And so that suggests that sort of diversifying assets, those that aren't strongly correlated with either asset class, could play a more important role in portfolios and portfolio construction. Thank you very much. Happy to take some questions.
Yep, we can swap. Why not? Great. Well, thank you very much, Olivia and Adam. Clearly, a lot of themes, sort of running amok at the moment, which we perhaps haven't seen for quite some time, if ever. And of course, I'm talking about things like high debt, ageing populations, deglobalization, geopolitical risk, etc. And it seems like all of these things could have pretty material impacts on inflation and economic growth going forwards, and therefore on the prospects for the various asset classes that investors can invest in. So we've got more than 10 minutes for questions. God, we're actually running on time. That doesn't normally happen. And we have a question from Dale. Thank you, Dale.
Thanks very much, and thank you for your presentation. I thought it was very good, and I concur with many of the things that you've said. Not wanting to rehash a lot of my thoughts, but Andy knows these already. As a trustee of a charity who has a benchmark of inflation plus 4%, my biggest concern is not the 1970s, it's actually the 1930s, where I think we're in a similar position now to what we were then, which is you have a trade tariff potential catastrophe on the horizon. If the person in the White House doesn't reverse course, we could see a number of rounds of trade tariffs similar to Smoot-Hawley in the 1930s, which led to trade decreasing by 50 or 60%. And contrary to a lot of economic thought on tariffs being just a blip to inflation and it's just a one-off hike, I think if you have a number of rounds of that, you could be in a position where you have a 5 to 10 year period where you're potentially in a stagflationary environment. And my concern is, what do you invest in? Because your typical inflation hedge of equities may not, be the case for 5 or 10 years. What do we do as a charity in terms of looking at asset allocation from a strategic perspective? Yes, I get the idea that gold is a potential inflation hedge, but you're not going to be putting 20 or 30% of your portfolio into gold, right? So what do you invest in? Because I agree, correlations will tend to 1 in that sort of environment, and both stocks and bonds will likely go down at the same time. So what do you invest in? Do you invest in digital assets? Do you invest in property, farmland, things like that? What are your thoughts?
Yeah, I can start. So I think to sort of start with the inflation question, some of our own work suggests that the sort of tariffs that Trump was at least touting on the campaign trail wouldn't necessarily put us all the way into the high inflation environment of the 1970s, or sort of into the high single digits. I think there's quite a lot of promises on the campaign trail, but the vibe was 10 to 20% universal tariffs and perhaps higher rates of up to 60% on China. Our working estimate was that you get a direct impact on US inflation of somewhere in the region of 1 to 1.5 percentage points on that. And that's before accounting for any of these second round effects, such as effects on wages. That would really come down to how the Federal Reserve responds. I think in the UK, things are a little bit less certain. This is what you hear from central banks, such as the ECB and the Bank of England. They're not entirely sure which way inflation will go if you get high tariffs in the US. It all comes down to retaliation from Europe. You've got the offsetting impact on demand versus the sort of physical impact of higher tariffs potentially. So I think it's very difficult to say exactly what eventual impact tariffs will have on inflation for a start. But on the second part of the question, on sort of how you look at this from an asset allocation point of view, one of the things that we're increasingly looking at is sort of these, what we would call actively managed strategies, in particular things such as trend following strategies or macro strategies that tend to have a reasonable track record in environments of higher macro volatility or higher inflation. It's difficult to go too far back in the past because a lot of these strategies weren't around if you go really sort of far back. But I've seen examples of research in academia that tries to replicate them back further into history. And you've got to sort of take them with a bit of a pinch of salt, but they show relatively reasonable performance during periods such as the 70s or the 1930s or the 1910s, for example, where they're just trying to sort of profit and benefit from some of this sort of heightened volatility. So that's one potential alternative.
I think I'd also just make the comment that we're obviously talking about broad-based asset allocation here, but I think in the environment you've constructed, stock selection, investment selection is key, particularly stock selection, because tariffs are clearly one area, but in a stagflationary environment, what you really want is growth, genuine growth, and you will have industries and equity sectors that are benefiting still very much able to grow in that scenario, certainly if they're exposed to other structural growth drivers. AI is an obvious one at the moment. And those should be able to deliver earnings growth that can outstrip inflation at whatever high level that might be. So stock selection, I think, is as important as asset allocation in that more challenging environment, and identifying those sectors and companies that are able to combat it well.
Got one just at the back first. Yes, please. Thank you.
When growth and population were being talked about, India never seems to get mentioned. So isn't it 1.25 billion people, recent growth rates of up of 8% a year? Why does it get... I don't mean... I notice generally it seems to be left out of investment. Anyway,
I think that, and there's a more general point, isn't there, about developed markets, I guess, because I noticed the presentation was more skewed towards developed markets, and it would be interesting to get any perspectives on the emerging markets, I think, as well. Thank you for your question.
Yeah, it's a good question. India is certainly an interesting prospect. And if you could actually flick a couple of...
Going forward,
I think if we go forward, there's actually a couple of appendix slides, potentially. Or perhaps not, never mind.
I'm not sure they've made sorry.
But it's a good point. India's population growth, or working age population growth, is strong compared to advanced economies and economies such as China. It's perhaps not as strong as it was 10, 20 years ago, but there's a huge amount of untapped potential. If we look at things like female labour force participation rates, they are extremely low in South Asia, lower than the likes of Saudi Arabia. So there's definitely untapped potential there in terms of the labour force. We're in general quite positive on India's economic outlook, both from a demographic point of view, but also an investment point of view. We've seen a huge move towards stronger public investment in India over the past few years. That was sort of a structural weakness of the Indian economy that's hopefully slowly being rectified. Things such as there's an expressway running from Delhi to Mumbai that's under construction, reducing the travel time there from 24 hours to 12 hours. That sort of thing just wasn't happening 10, 20 years ago. And they're using it to route fibre optic cables between parts of India as well. So in general, we're pretty positive on the economic outlook in India. Perhaps a little bit less positive on the stock market story. Valuations in India are quite elevated. We've done some work to try and sort of account for sectoral differences across regions. And even once you do that, India looks extremely expensive, far more so than even the US. To an extent, that's perhaps justified if you believe the domestic economy is going to do particularly well. But I think our view is that it looked, even with ambitious growth expectations, quite highly valued. And I think you've seen a little bit of the air come out of that over the past 6 months, actually, when the market's down sort of 10 to 15%.
Yes.
I think I've just managed to blow up the presentation. Oh, no. It's going Sorry, hang on. We might be able to...
If we skip through, keep going.
One more?
2 more, I think, from here.
There we go, India.
Yeah, this one. Okay, yeah. So these are stock market valuations for the US, the rest of the developed world, the emerging world, and India specifically. And we've adjusted, like I say, for the fact that India has particularly high weight in industrials and materials and that type of sector. But even once you do that, it's quite stark how highly valued the market is. And like I say, to an extent, some of that is justified, but yeah, it's a lot is in the price, I think, is how I'd say.
We had a question here first, actually. Lady here, and sorry, I don't know your name. Apologies.
Mine was a comment on the emerging markets and the influence of the global south, dollar weakness, what you think will be happening there. I just thought it was missing from what was said. It's such an important sector, isn't it, going forward the next 10 years, really?
Okay.
Yeah, I think China is obviously the other major economy in the emerging world, and our view on the economic outlook there is relatively downbeat, in that we expect the sort of structural slowdown that we've seen over the past 15 years or so to continue. The demographics in China are particularly poor. I'm not sure, I think that it was on that chart I showed earlier where the working age population is expected to decline at a faster rate than the EU, for example, which is, when you think of an aging population, Europe is your first thought. So there's the demographic headwinds. We also think the investment-led economic model is sort of starting to run out of road. China's had an incredibly high investment rate for decades and decades, but you're starting to see issues with overcapacity in the housing sector in particular, but also in infrastructure. China has world-class infrastructure in things like high-speed rail. There's just a limited number of profitable investments for the government to undertake now. And I think on top of all of that, you've got a bit of a slide back towards more state involvement in the economy under Xi Jinping. Now, that isn't always an issue for development. There are examples of countries that have gone through very quick development with state involvement, but I think the focus on sort of strategic independence and the party involvement are perhaps issues if you compare it to, say, a Korea or Japan, where it was all about exports. China's trying to do this in an environment of global economic fracturing and deglobalization. I think that's quite a bit harder than it would have been for the likes of Korea, for example.